Hey, Derek, it's good to see you. I'm really excited about today's topic, RMD strategies to reduce your tax burden. I know that you're always thinking of strategies to help your clients reduce their taxes. So we're going to talk about those required minimum distributions
hmm
because proper planning is vitally important. So let's start at the top. What are RMDs and how are they calculated?
Yeah, RMDs very simply are a distribution that's required to be taken every year when you reach the age of 72. It's a distribution that is taken from IRAs, 401ks, from all those accounts that we're putting money in and taking a tax deduction when we were working. So, what they do in very simple terms with the IRS is they're taking your account balance in the year in which you turn 72, and they're taking a life expectancy factor off their table and they're equaling out to your RMD distribution each year. And that's recalculated every single year. And it's an increasing table. So every year it's an increasing distribution from the age of 72 forward, basically for life.
All right. So now let's
Mhm.
talk about those penalties because I know you work really hard to make sure your clients take the
Yeah.
distributions when they need to, because if they don't, those penalties are steep.
Excessive is a
Yeah.
maybe a better word.
Yeah.
If you would have forgotten to take your RMD, meaning you reach the age of 72 or 73, 74, and you forget in a particular year to take a distribution, um, let's use an example. If we had a $4,000 distribution from RMDs this year and you forgot to take it and you remembered in January, well, when you go back in to take that distribution, the IRS can assess you a penalty of 50% of the funds you didn't take. So on a
Ouch.
$4,000 RMD, that's a $2,000 penalty on top of the required distribution
Yeah,
that
that
you
is
had to
painful.
take. So pretty painful.
Yeah. All right. So let's run through then the three strategies to
Mhm.
reduce the tax burden that comes with those RMDs. First, on your list of consideration, taking them as early as possible at age 59 and a half. Why is that?
Yeah, so taking distributions or beginning RMDs or a systematic withdrawal from your retirement accounts early is an easy way to control taxes. We
Mhm.
see a lot of clients make a mistake in retirement planning by they'll say, well, my IRAs I don't need to use until I'm 72. And then what they do is they spend down maybe cash savings, maybe non retirement investments or Roths. They spend those down prior to age 72, waiting for the RMD. Well, the RMD is something that you're going to have to take from 72 for life. So we like to get clients in the kind of the pattern of getting used to that income source. It's
Mhm.
going to be an income in the future. So getting used to it allows us to bracket in a set income. It allows us to control your taxes more appropriately by setting the proper federal withholding and the state withholding. It's just an easier way to handle. And from a tax advantage perspective, it's a great way to go.
Right. Makes a lot of sense.
Mhm.
Next on your list, Roth conversions. Everybody's talking about them.
They are. So Roth conversions for clients or families that maybe look out at their plan, proper planning, you look at the RMDs for the future. If we have clients that are receiving pensions and Social Security in the future, and they're not going to need that required distribution each year to meet their household expenses or have a purpose for that funds, someone might consider a Roth conversion. The Roth conversion allows you to convert any or part of your IRA to a Roth, which is tax free. And the best part, Aaron, is you don't have RMDs.
Right.
There is no RMD distribution. So you can let that Roth grow for maybe 10, 20, 30 years, and you aren't required to take distributions from it. Roth conversions are wonderful. There's a lot of nuances that the IRS has, like a 5-year rule that it needs to sit there. So proper planning needs to be done around them, but it could be a consideration for the right client or right situation.
Right. That's why we're having these conversations now,
Mhm.
Derek, because the earlier the better. Last on our
Always.
list of considerations, qualified charitable distributions. I like these because it's just a win-win for everybody. What is it?
I love it. So, with clients that are in a routine of giving to charities, that could
Mhm.
be churches, that can be organizations, any charity, a 501c3 charity. What the IRS has basically set up is a beautiful rule that allows someone that is age 72 and taking an RMD, they allow you to give any portion or all of the RMD on your choice over to charities directly. By doing that, going directly from your IRA to the charity, Number one, it lowers your taxable income because RMDs are taxable income to you.
Hmm.
So if we were taking $20,000 in RMDs a year and you were donating yourself 10,000 to charities, well, you can go directly from your IRA and you can lower your taxable income from 20,000 in that example down to 10,
Wow.
and you're meeting your charitable contributions. And it's just a wonderful way and a tax advantage play. So any
Mhm.
household that is charitable giving definitely need to consider the qualified charitable distributions at 72 or older.
Absolutely. And so I just want to kind of underscore what we're talking about here, which is
Mhm.
strategic tax planning. Because, of course, as you mentioned before, RMDs are considered income, which
They
brings us back to that common misconception that we'll be in a lower tax bracket when we retire, because that's not always the case.
Yeah, it's definitely. I see a lot of planning that's done where clients will come in and go, "Well, I've done it as a self investor. I've planned out everything." And considering the RMDs is very important. So
Hmm.
in the future, that income, the IRAs and RMDs are going to be an income source for you.
Right.
So one of the best strategies I think you can do when you start looking at your own individual planning, working with your advisor, is to really look at how the RMDs can be used for an income source in the future at 72, right? There's many different strategies to utilize them. Uh, Myself as an advisor with my clients, I always want to look at IRAs and accounts as income generation in the future, including Social Security, pensions, military, all the above.
Hmm. So much to consider. Like we
Mhm.
said, kind of the earlier the better with these conversations. Derek, it
Always.
was really helpful to walk through this with you. If somebody has any questions about something we've covered, what's the best way to reach you?
Yeah, they can reach out to the office. Phone number at the office, 703-273-2326. They can also reference the website at threeleaffinancial.com and schedule an appointment time from there.
All right, Derek, thank you.
Thank you, Aaron. I appreciate it.